Welcome back. The Federal Reserve is expected to raise interest rates for the third time in December. The Fed funds futures are currently pricing in a 98.7% chance of an interest rate hike in just a couple of weeks. So what does that mean for the markets headed into 2018? My next guest voted in favor of the first two interest rate hikes this year. Joining me right now is the president and CEO of the Federal Reserve Bank of Dallas, and he's a voting member of the FOMC, Robert Kaplan. Good to see you, sir. Thanks so much for joining us.
Good to see you, Maria.
So can you characterize the backdrop for us? I mean, you recently said you are actively considering voting yes for another interest rate hike come December, in the December meeting. Give us a sense of why that is the backdrop in terms of the economic story today.
All right. So here's the backdrop. Our own forecast of the Dallas Fed is we're going to grow about 2.5% in 2017. Sluggish by historical standards, but it'll be sufficient growth to continue to, in our view, drive down the unemployment rate, which is right now 4.1%. But more importantly, I look at U6, which is the unemployed plus discouraged workers plus people working part-time. That's 7.9%, but even that's at a pre-recession low. We think that's going to continue to decline. So we're getting near full employment. On the inflation front, a lot's been made of the fact that we are running behind our 2% target. We can talk more about why that is. A lot of that, to me, is structural headwinds, particularly technology-enabled disruption. That's not going away. So we kind of have a situation where we're meeting one element of the mandate and not meeting the other. We're at 100 to 125 basis points in the Fed funds rate. My own view is if the degree of the overshoot of full employment is going to be big enough, even though we're lagging in our meeting our inflation target, that alone might be enough to convince me that we ought to take the next step in removing accommodation. But that's the background we're struggling with. We're meeting one mandate, we're not meeting another. And that's the thing we're wrestling with.
Yeah, all of this as you're about to get a new leader of the Federal Reserve, Jay Powell. Is there any reason to believe that Powell's sort of mentality toward where rates should be, toward the backdrop in terms of what drives economic growth are different than what Janet Yellen has been doing?
And the good thing about having Jay been on the FOMC for the last 5 years, and I've worked with him closely the last two, his views on monetary policy have been are well known, well articulated, and so I think it suggests we'll have a continuity in approach against the backdrop. We should be re-reviewing our governance, whether we can operate better. We should be doing a regulatory review, and Randy Quarles coming on is part of that, and I know Jay has spoken up about that, and I think we need to give. I personally think we need to give relief to small, mid-sized banks as a priority, and so even though people around the FOMC table will change in the years ahead, I think having Jay Powell as chair tells me we'll have a consistent approach. Good, rigorous debate, disagreement, and sound decision-making.
Alan Greenspan always used to say to me when he was in the job, the wealth effect is important. Watching where markets go is important. It adds to the backdrop in terms of decision-making on interest rates. So how do you see the current situation where this market is up $5.4 trillion in value just since last November, the election?
All right, so I'll mention some of the things I look at, and I think they're manageable, but I take note of them, to your point. Number one, U.S. market cap to GDP is about 140% now. The last time it was at this level was 1999-2000. We've gone about 15 months without a 3% decline in the U.S. stock market. That basically is unprecedented. And the last market you can go to that went 15 months without a 3% decline was the Japanese market of 88 and 89 before it went down substantially. I don't think we're Japan, but it's worth noting that. Margin debt is at record highs, which is not surprising given we're about $550 billion, not surprising. The other thing I look at is what concerns me a little bit. Trading volumes in debt and equity securities are lower than they were 10 years ago. Part of that may be low volatility, but part of it may be impact of regulation, including the Volcker rule. So I'm not sorry if we do a thorough review of the Volcker rule and sort of just connect that with, is that part of the lack of trading liquidity? Because what I'm watching for is not so much our valuation level's too high. I'm watching for excess debt buildup and imbalances associated with it. And you know there are going to be ups and downs. You just want to make sure we can handle it in a way that doesn't cause a rapid tightening in financial conditions like what we had in the first quarter of 2016, which in turn could cause economic conditions to deteriorate rapidly. And those are the things I'm watching for in terms of imbalances. I think we're manageable today, but I think we'd be wise to be vigilant to monitor this.